What the U.S. rate rise means for Australia. The U.S. Federal Reserve has finally hiked rates, but don't panic. The U.S. Federal Reserve lifted the Fed funds target rate from 0.25 to 0.50% to 0.50-0.75% in a unanimous decision. In addition, the Fed commentary suggested 3 rate hikes in 2017, up from 2 at the September meeting. The FOMC statement highlighted that near-term risks to the economic outlook appear roughly balanced, but when it comes to inflation, market-based measures of inflation compensation has moved up considerably but still are low. U.S. share markets fell after the Federal Reserve lifted the interest rate outlook for 2017. Ahead of the interest rate decision, markets had been in a holding pattern. At the close of trade, the Dow Jones index was lower by 119 points or 0.6%. The S&P 500 index was down by 0.8%, while the Nasdaq fell by 27 points or 0.5%. It's good news for Australia, and the Reserve Bank isn't going to rush to raise rates just yet, economists say. The resumption of Fed rate hikes is a sign the world's biggest economy is doing well, S&amp Capital chief economist Dr. Shane Oliver wrote. To the extent that the Fed's interest rate hike signals are stronger US, it's good for Australia. It doesn't signal that the RBA will soon follow and hike next year, though. Dr. Oliver said with the Australian economy remaining weaker relative to its potential than the US and inflation running below target, his view was that the RBA would be cutting rates further in 2017, not hiking them. That doesn't mean Australian homeowners should relax completely. NAB, Westpac, Bank and a number of other lenders have already raised rates out of cycle with the RBA, and LJ Hooker chief executive Grant Herrod earlier this month warned of more to come. At its final meeting for the year, the RBA left the official cash rate on hold at its historic low of 1.5% after 2 cuts in 2016. As we've seen with some major lenders, the banks have the full capability to adjust their own lending policies and will likely see more of that in 2017, Mr. Herrod said. Mortgage Choice CEO John Flavel, however, said an RBA rate hike was on the cards and warned Australia's lenders would continue to raise rates in 2017 against a backdrop of increasing funding costs. The Federal Reserve announcement, combined with the fact that many of Australia's lenders have started to raise rates across their suite of home loan products, would suggest a cash rate increase by the Reserve Bank of Australia is now more of a possibility than not in 2017, Mr. Flavel said. The RBA had previously stated that the easing bias has passed, and the latest changes by the U.S. Central Bank would support this. Of course, even if rates rise, it is important for borrowers and potential borrowers to keep in mind that interest rates will still be very low by historical standards. Any rate rises are likely to be small, which will help keep the cost of borrowing incredibly affordable. As a result, I would expect certain parts of the property market to remain strong. According to Dr. Oliver, the main relevance of the U.S. rate hike is that it helps keep the Australian dollar down. This is essential if Australia is to continue rebalancing its economy as mining investment continues to unwind and the housing construction cycle peaks in 2017, he wrote. We see the dollar falling below 70 US cents in 2017. Saul Eslake, independent economist and vice-chancellor's fellow at the University of Tasmania, agreed the main impact would be a lower Australian dollar, but said the lower dollar would reduce the need for the RBA to cut rates. It certainly doesn't mean the RBA will raise rates, he said. The RBA hasn't mechanistically followed what the US Fed does since the mid-1990s, partly because Australia's economic cycle is no longer as closely aligned to the US, and partly it reflects the shifting patterns of our trade. The main impact will be a weaker Australian dollar, and that's what the RBA wants to see. They've made the point on a number of occasions that cutting rates isn't as effective at boosting demand as it used to be. Given how much household debt there is, households aren't as willing to borrow at low interest rates as they used to be. Whereas if you are affected by the currency, you don't need to take on more debt in order to benefit from it, you are just more competitive. Unless the dollar falls so much that it starts feeding into a rapid climb in inflation, the RBA won't see any need to raise rates. Steve Cates, associate professor of economics at RMIT, said it was good news for the US and could be for Australia if it followed suit by raising rates. Low rates will kill you, he wrote. It's all part of economic resurrection. It may cost more to get your hands on money going forward, but it is also more likely that the higher cost of borrowing will help channel our savings into more productive projects. The belief that low interest rates are good for growth may be the worst illusion of all, causing one economy after another to fall into a low productivity trap from which it is almost impossible to find a way out. At midday, the Australian dollar was trading at 74.04 US cents, down from 74.89 US cents on Wednesday, and sharply lower than its level above 75 US cents ahead of the Fed's announcement at 6 a.m. The Fed's rate hike explained. What did the Fed do? The Fed increased its benchmark interest rate, the so-called Fed funds rate, to range of 0.5–0.75% from 0.25 to 0.5%. The rate is still extraordinarily low. During the financial crisis, the Fed slashed the rate to near zero and kept there for 7 years. On December 16, 2015, Fed policymakers raised the rate for the first time since 2006. Why did the Fed decide to raise rates? The Fed said Wednesday that the American job market looks strong and the overall economy is expanding at a moderate pace. The unemployment rate fell in November to a 9-year low 4.6%, and the economy expanded from July through September at a 3.2% annual pace, fastest in 2 years. The Fed expects inflation to edge up and closer to its 2% annual target. What will it mean for U.S. consumers and savers? Not much, experts say. The Fed doesn't directly affect rates on auto and student loans, but credit cards, home equity loans and adjustable-rate mortgages are based on benchmarks such as the bank's prime rate, which moves in lockstep with the Fed funds rate and could rise soon, though likely not by much. Long-term mortgage rates are already climbing, but not because of the Fed. Investors have driven mortgage and other long-term rates higher because they expect President-elect Donald Trump's plans to slash taxes and increase infrastructure spending will lead to faster economic growth and higher inflation. Will the hike have broader economic implications? Economists don't expect the higher borrowing costs to do much harm to steady but unspectacular U.S. economic growth. But higher U.S. rates are likely to draw investors away from the rock-bottom rates in Europe and Japan. Turning to U.S. investments, they are likely to drive up the value of the dollar, which is already near a 14-year high. A dearer dollar makes U.S. products costlier in foreign markets and hurts American exporters. A higher dollar will also squeeze foreign companies that borrowed in U.S. dollars to make loan payments. They will need to exchange more of their cheaper local currency into American dollars. What happens next? Fed policymakers expect to raise rates 3 times next year. They see the Fed funds rate at 1.25–1.5% by the end of 2017, to 2.25% by the end of 2018, and 2.75–3% by the end of 2019. Source: AP.